What if I told you there's a single line on a Bitcoin chart that has predicted major bull and bear markets with startling consistency for over a decade? It's not some obscure indicator. It's not a secret algorithm. It's one of the oldest, most watched tools in all of trading. It's the 200-day simple moving average. And today, we're going deep. Welcome back to Schooled by Market, the channel where we let the charts do the talking. I'm going to walk you through something I find genuinely fascinating about Bitcoin's 200-day moving average, a pattern that once you see it, you cannot unsee. We're going to cover what the 200-day SMA actually is and why traders care about it, the specific pattern that shows up in Bitcoin's price history almost every single time, the few exceptions and what they tell us, the stats, the averages, the edge, and finally, where we are right now and what history says comes next. This video is data-driven. No hype, no price predictions, just the market teaching us if we're willing to listen. Let's go. All right, quick fundamentals, because even if you've heard of this before, it's worth getting the foundation right. The 200-day simple moving average, or the 200-day SMA, is exactly what it sounds like. It takes the closing price for the last 200 trading days, adds them up, and divides by 200. You get a single data point. Do that for every day, connect the dots, and you've got a smooth line that follows price over time. It's a long-term filter. It strips out the noise, the daily swings, the weekend pumps, the panic sell-offs, and shows you the bigger picture, the actual trend. Now here's why it matters. When price is above the 200-day SMA, traders generally view the market as being in an uptrend. Bullish, risk on, buy the dips territory. When price is below the 200-day SMA, that's a sign of weakness. Bearish, the broader trend is down. The 200-day SMA acts like a dynamic line of support and resistance. Price bounces off it, stalls at it, sometimes rockets through it. Swing traders use it to time entries and exits. Long-term investors use it as a compass. And during corrections and bear markets, it becomes one of the most important lines on the whole chart, because it can tell you, is this a temporary pullback or is something bigger happening? Okay. Now we get to the interesting part. Here's the finding that really caught my attention when I was analyzing Bitcoin's price history. Whenever Bitcoin spends more than 90 consecutive days above its 200-day SMA, it is historically more likely to stay above it for another 90 days. And the same goes in reverse. Whenever Bitcoin spends more than 90 days below its 200-day SMA, it is historically more likely to stay below it for another 90 days. That's not how you'd expect a random market to behave. That's momentum. That's trend persistence. The 200-day SMA doesn't just describe the trend, it reinforces it. Let me show you this visually. Here you can see the historical stretches where Bitcoin traded above the 200-day SMA. Look at these runs. We're not talking about a few weeks. We're talking about months, sometimes approaching a full year of sustained price above the average. And it's not a coincidence. Once Bitcoin crosses that 90-day mark above the line, momentum has clearly shifted. The market has made a decision, and it tends to follow through. Now flip it around. Same story on the downside. Here are the historical periods where Bitcoin spent extended time below the 200-day SMA. Same pattern. Once you cross 90 days below, you tend to stay below. These are the bear markets, the long, grinding, painful bear markets. The 90-day mark is like a confirmation signal in both directions. Cross it to the upside, the bull run is likely to continue. Cross it to the downside, buckle up. It's probably not over yet. Now, I would not be doing my job if I didn't show you the exceptions, because there are exceptions, and being honest about them is kind of the whole point of this channel. Exception number 1, 2019. Bitcoin crossed the 90-day mark above the 200-day SMA. Everything pointed to continuation, but then the streak ended at 177 days total. That's 87 days after the 90-day threshold. Now, technically, that's an exception, but I'd call it a minor exception. The pattern still held for almost 3 months after the signal fired. It's not like the market immediately reversed the next day. Exception number 2, late 2024 into 2025. This one's more recent and more important to understand. Again, Bitcoin crossed the 90-day threshold above the SMA. Streak ended at 164 days total. That's 74 days after the signal. Again, a minor exception in the grand scheme, but this one matters because it's recent. Exception number 3, mid-2014. This one's on the bearish side. Bitcoin had spent more than 90 days below the SMA, a clear bear signal, but instead of continuing lower, it popped above the line for 25 days before rolling back over and resuming the bear market. A fake-out, a bull trap, painful for anyone who thought the bottom was in. Exception number 4, 2021. Bitcoin spent 90 days below the SMA, the signal was bearish, but, and this is a good one, Bitcoin went on to set a marginally higher all-time high before rolling over and collapsing into one of the deepest bear markets in its history. This is the exception that haunts traders. You could have been right about the big picture, the 200-day SMA was warning you, and still gotten wrecked if you shorted too early. So what do these exceptions tell us? They tell us this is a probabilistic edge, not a crystal ball. The pattern is real, the statistics back it up, but no indicator works 100% of the time, and that's okay. That's trading. The goal is to find signals that give you an edge over time, and as we're about to see, this one does.
All right, let's talk numbers. This is where it gets really concrete. Periods where Bitcoin stayed above the 200-day SMA for more than 90 days. Number of times this happened, 9. Average duration of the streak, 383 days, that's over a year. Shortest, 164 days, just over 5 months. Longest, 885 days, nearly 2.5 years. Periods where Bitcoin stayed below the 200-day SMA for more than 90 days. Numbers, 7. Average duration, 288 days, about 9.5 months. Shortest, 90 days. Longest, 388 days, just over a year. Let that sink in for a second. When Bitcoin commits to a trend above or below the 200-day SMA, the average follow-through is measured in months, not days. Bull runs above the line average over a year, the longest, nearly 2.5 years. Bear runs below the line average around 9 months, the longest, over a year. This is why the 200-day SMA matters so much for longer-term positioning. It's not a day trading tool, it's a big picture compass. Now, if you have stayed here till now, I want to give you a bonus signal. Let's take a quick detour, because there's a closely related metric that adds another layer to this analysis. It's called the Mayer multiple. Simple concept. Take Bitcoin's current price, divide it by the 200-day SMA. That's it. When the Mayer multiple is above 1, Bitcoin is trading above the average. When it's below 1, price is below the average. But here's the fascinating part. Historically, whenever the Mayer multiple drops below 0.6, meaning Bitcoin is trading at less than 60% of its 200-day SMA, that has been considered deep value, a generational buying opportunity, every single time. And here's where it gets interesting for right now. During the market capitulation in early February this year, the Mayer multiple hit a low of 0.61. Technically, it didn't quite breach that 0.6 threshold, but it came close, very close, which raises a question. Is the market front-running this metric? Are sophisticated buyers stepping in just above that magic number, knowing it represents historically deep value? Or is the worst not yet over? Could we still see a flush down below 0.6? I don't have a definitive answer, but I think this is one of the most important questions anyone watching Bitcoin right now should be asking. So, where does all of this leave us right now? At the time this data was analyzed, the 200-day SMA was sitting at approximately $88,000. Bitcoin was trading around $72,900, well below the line. Bitcoin had been below the 200-day SMA for approximately 164 days.
Now remember our stats. The average duration of a below 200 SMA streak is 288 days. If this streak follows the average, that implies roughly 4 more months of price trading below the 200-day SMA. The worst case in Bitcoin's history was a streak of 388 days. If this one gets that bad, we could be looking at another 7 months before price reclaims the average. Now, I want to be very clear, these are statistics, not prophecies. The market doesn't owe us the average. But if you're asking what history says, that's what history says. And there's something else to watch. The 200-day SMA itself will likely act as a strong resistance level on any bounce. Price will need to fight to get back above it. And even if it does, history shows that reclaiming the average is only half the battle. Staying above it is the other. So, keep your eyes on that line. If Bitcoin bounces from here, the 200-day SMA is the key level to watch. Can it reclaim it? Can it hold above it for 90 days? That would be the signal that the tide has truly turned.
All right, let's wrap this up with practical takeaways. What do you actually do with this information? Number 1, the 200-day SMA is your macro compass. If you're a long-term Bitcoin holder, keeping track of whether you're above or below the 200-day SMA should be a baseline check, not a trading trigger, a compass. Number 2, 90 days is the key threshold. Short-term noise happens all the time, but when Bitcoin crosses 90 days either above or below the 200-day SMA, it historically signals that momentum has shifted. Pay attention. Number 3, the Mayer multiple below 0.6 has historically been exceptional value. We got close in February this year at 0.61. Whether we get another crack at those levels or lower is uncertain, but if we do, history says it's been worth paying attention. Number 4, manage your risk accordingly. The exceptions will happen. They always do. The 200-day SMA is a probabilistic edge, not a guarantee. Size your positions accordingly. Number 5, be patient. The average bear market streak below the 200-day SMA is nearly 10 months. If we're in one right now, and the data suggests we are, expecting a quick recovery might be wishful thinking. Patience is a strategy. And that's it. The 200-day SMA, one of the oldest tools in trading with a surprisingly powerful pattern in Bitcoin's history. The market has been teaching this lesson for over a decade. The question is whether we're paying attention. If you found this useful, drop a like, share it with someone who's trying to make sense of the current market, and subscribe so you don't miss the next deep dive. I'll be watching the 200-day SMA closely. When something significant happens, a reclaim, a key bounce, or another test of support, I'll break it down here. Until then, the market is teaching. Are you listening? See you in the next one.